Hi everyone, very good evening. You're watching The Money Show on ET Now with me, Mubina Kapasi. This is our Rise with India Prime Time segment, and The Money Show is dedicated to helping you with all your money-related questions. Here's what we have lined up for you on the show. First up, we're going to be talking about the inflows of December. Which equity mutual fund category saw inflows? Which one did garner investor interest? That's what we will be discussing. And later on the show, we'll also be talking about the new SBI home loan scheme that is expected to instill some confidence in the home buyer. Which projects is it applicable to? Should you opt for SBI's new home loan scheme? That's what we will be discussing. And of course, finally, we'll also have the CPI data, which will tell us what's become more expensive and what's not. But before we do any of that, here's taking a look at the headlines. New day, new records. The Nifty and the Sensex end at record closing highs led by gains of 0.3%. The mid-caps gained for the fifth consecutive session. IT and realty indices gained the most. The big voice on ET Now, billionaire investor and an eternal optimist, Rakesh Jhunjhunwala says the year 2020 will belong to mid and small cap names. Says the economy has bottomed out and a full-blown recovery is only a matter of time. All eyes are on the December retail inflation data as the street expects inflation to rise above 6%. Experts expect the food prices to drive inflation upwards, but they do expect core inflation to remain stable. Bombay Dyeing Chairman Nusli Wadia withdraws defamation cases, including the 3,000 crore rupees suit against the Tata Group Chairman Emeritus Ratan Tata and others. The move comes after the top court had both of them talk it out and resolve their differences. Walmart India lays off 56 employees in its Gurgaon office, calls it a routine review to ensure they operate more efficiently. Rules out another round of layoffs, calling the news incorrect and baseless. Mamata Banerjee and Mayawati both skipped the opposition parties' meet on the Citizenship Amendment Act led by Congress. Arvind Kejriwal also stays away, says AAP was not invited. Well, those are the headlines that you should be tracking, and you will be able to track all evening on ET Now. But let's kickstart the Money Show first up by introducing our guest for today, Nikhil Kothari of Etika Wealth Management. Nikhil, thank you so much for joining in this evening on the Money Show. Nikhil, we saw the December data, and it's interesting to note that, yes, finally there was a bit of a bounce in December after those weak equity inflows. It looks like people are once again putting their money back in the equity mutual funds. If we have to look at overall mutual funds, though, it was interesting to note that the outflows were led by liquid category, which means people were actually removing their money from liquid, funds. But multi-cap funds, focused funds, these saw tremendous amount of inflows coming in. So first up, Nikhil, I want to get in your opinion. What do you make of all these flows that we are seeing across different mutual fund categories?
So basically, if you look at, there was the last 3 months, but the good part of the whole thing is that the SIP's number has not come down. The Indian investors have been investing through SIP inflow, and that number remains static and or it's growing over a period of time. So that's a healthy sign that over a period of the saving culture has remained intact from the Indian investor perspective. So if you look at broadly the inflows this year, the most of the inflows have been in the large and mid cap category, the small cap category, and the value category. So the beaten down sectors or beaten down the category has been seeing the good inflows. So that's a healthy sign again as compared to the pure large cap category. So broadly, the liquid fund outflow has been more because of December quarter. You have advanced tax outflow, some money goes out from there. But on the equity side, the revival of if you look at last 3 months, there have been some revival in the broader indices. So not only the Sensex, but the broader indices has shown some uptake, and because of that boosts up again the investor confidence, and that's the reason we are seeing good inflow in all these categories.
Yeah, I mean, compared to a large cap fund or a mid cap fund, it's the small cap fund that's actually shown a lot of interest. And Nikhil, we often get this question from our viewers who are watching us that I've invested in so and so small cap fund about 2 years ago, and now I'm losing money. So what should I do? I suppose now, and we had Rakesh Junjunwala as well tell, ET now that, 2020 is going to be the year of mid caps and small caps. And while, of course, mutual funds should not be looked at like that on a yearly, basis, but do you think now is a great time to perhaps increase your SIP in a small cap fund or a mid cap fund?
So if you look at the overall market, in the last 2 years we've seen that the Sensex or the Nifty has been going up. But if you look at the mutual fund portfolios or the individual investors' portfolio, they have not seen that much growth. The reason primarily being is that if you're invested if individual investors normally invest in mid and small cap stocks, and that has not seen any uptick. And same goes for mutual fund. Only a large cap mutual fund, predominantly who invest in only large cap stock, has seen an uptake. But if you look at the broader funds like a multi cap or a large and mid cap, they have not seen the massacre in terms of falling, but they've not seen very high return in last 2 years because they invest in diversified portfolio. If you look at the broader valuation, the small cap index is really down, considering last 2 years is broadly down by 20-25%. Mid cap is down by 15-20%. So from a valuation perspective, the small and mid cap looks a very attractively valued proposition. And with the interest rate coming down, it's also going to benefit on all the mid and small cap companies on the interest outflow. And as soon as the economy revives, I'm seeing the small and mid cap will see good amount of order inflow. So from a valuation perspective, from an interest rate perspective, as well as from the revival of the economy, all these three should act as a good boon to the small cap as a segment. So from a valuation, I'll say that the new investors or the existing investor, when if you're trying to increase your SIPs, you can look at doing some allocation to small and mid cap. But please remember, small and mid cap will always be very, very volatile. So you should only allocate that part of your money which you can withstand the volatility. And overall portfolio should not be more than 20-25% of your mid and small cap, because that's the from an asset allocation you should have large cap, mid cap, as well as small cap categories. But on an overall portfolio, mid and small cap should not account for more than 30-35% of your portfolio.
Okay. Nikhil, there's also something called as focused funds, which has received a lot of inflow. A lot of investors have put their money on this category called focused funds. So if you could, tell our investors a bit about that. I mean, what exactly is it? Where do these focused funds invest? And what sort of a place should such focused funds, if any, have in an individual's portfolio?
So focus fund and the category in mutual fund arena. What basically this fund does is it runs more like a PMS. When we say the PMS runs a concentrated portfolio bet, same like goes for a focus fund. So predominantly they cannot invest in more than 30 stocks. So it's a concentrated portfolio. Now again, across the industry, there are few focus funds which are like a large cap bias and few focus funds which are mid and small cap bias. So one has to very clearly understand that which fund he is investing in and what biases the fund has. If you look at last 3 months, even the small cap as well as the focus fund has given a very healthy return. So, but again, if investors are coming, they should not look at only last 3 months return and just flow in that money there. Focus funds are very, very concentrated portfolios, so they will always be far more volatile as compared to diversified equity portfolio like a multi-cap or a large and mid-cap portfolio. So people who want to bet on concentrated portfolio can allocate some part of the money in focus fund. But as I said earlier, that you need to be very clear that whether the fund is a large cap bias focus fund or a mid cap bias focus fund, because there's no definition of whether you have to be large cap or mid cap. So different fund houses run different strategies, but it will be very concentrated portfolio, not more than 30 stocks. So every stock will have a good amount of exposure in terms of weightage. And again, from a portfolio allocation, you should not have more than 10% of your 15% of your portfolio in a focus fund.
Okay, all right, fair enough. The other fund where we are seeing a lot of interest is the multi-cap fund, because I think over there the inflows rose 3 times, almost as much as we saw in focused funds. So, often, Nikhil, the rule is that, okay, you should have like a good amount in, your large caps, and then like you mentioned, the portion of the, portfolio where you can afford a little volatility, can go in mid caps and small caps. What about multi caps, which essentially are spread across, large caps, mid caps, and small caps?
I will say multi-cap fund or a large and mid-cap fund, both more or less fall in the same category, should be a core part of your portfolio. So if you don't want to take a broader call whether mid-cap will do good or large cap will do good, multi-cap or large and mid-cap will give you good flavor because here the fund manager has the ability to move around mid-cap and small cap or large cap depend on the fund manager's outlook on the broader market. But in spite, even though he has a very positive view on one particular segment, he won't go overboard. So on an average, multi-cap fund will have 50-60% of the portfolio in large cap and 30-35% in a mid cap if he is very positive on the mid cap segment. So this portfolio gives you very good exposure across the market capitalization, and this should be a first if an investor is coming for the first time or he is a conservative investor, he should primarily look at multi-cap as a starting point. And over a period of time, depending on his volatility, his risk-taking capacity, he can add small cap or a mid-cap fund in the portfolio. But the core part of your portfolio should always be a multi-cap or a large and mid-cap portfolio.
Okay. Now, obviously not every fund category has seen, green on the screen. We also do have the thematic funds that have actually reduced in terms of the amount of inflow that has gone into these funds. But again, Nikhil, if you look at which have been the best decadal performers, you'll see a consumption fund stands out. In the last 1 year, we had public and banking sector, PSU and banking sector funds that really outperform on the debt side. So it really makes one believe that, a thematic fund can really outperform, I suppose, if you know the markets well, if you can time it well. So what is your stance on a thematic fund?
Personally, I'll say that if you look at broad mutual fund portfolio, you should be most of the time should shy away from thematic funds. The reason being is that it's very difficult to time which segment of the market will do good. And when you invest in diversified portfolio, if the fund man believes that infra will do good or a banking and PSU will do good, you will have the allocation more in those stocks or those sectors. So if from a diversified portfolio, you get that exposure. Because if you take a thematic fund, I've seen a lot of people have burned their fingers in 2008 when they put good amount of money in infrastructure or realty fund, and then for next 8 years, 9 years, they've not seen any return on the portfolio. So I'll say that most of the investors should shy away from thematic fund. They should ideally go with a multi-cap or large and mid-cap fund where the fund manager will change the sector exposure depending on his outlook on the particular sector. If you're a very, very savvy investor who understands the broader market, who can broadly time the market in terms of which themes to do good, then you can allocate that small amount of money in a thematic fund. But again, getting in thematic fund and getting out of thematic fund is very, very critical. Except, for example, as you rightly said, the consumer has done very good. If you look at last 3, 4 or 6 months, the consumer's fund has not done that great. So getting in a thematic fund and getting out of thematic fund is very, very critical. So if you're not a market expert, don't invest in thematic fund. And even if you're taking an exposure to thematic fund, should not be more than 5 to 10% of your portfolio.
Okay, so you have to be a bit more savvy to be able to really get that rally when it does rally, in one of these thematic funds. Like Nikhil said, okay, if you look at it on a decadal basis, which is pretty long term, you will notice that FMCG has done well. But then again, the last 1 year, it's not been that great. Okay, let's do one thing now. Let me also invite all our viewers to ask any questions or queries that they may be having. We'll kickstart our Ask TMS segment. The numbers appearing on the top of your screens, 24990300. But in the meanwhile, I'm going to take on board some email queries that we have received. The first one is from Radhakrishnan R. He writes into us saying that I'm 67, a pensioner, and I made the following investments 18 months ago. I want to reduce my investment in 2 mutual funds. Time period is 3 years from now. Okay. So it's just been a year and a half since he's investing, and now he has only 3 years from now. He's put, and they're bulk investments. 2 lakhs in a Mirae Asset hybrid fund, just about 1.5 lakh in HDFC hybrid equity, 1.9 lakhs in principal hybrid equity, and 2.4 lakhs in ICICI Prudential equity and debt funds. So I think they're all hybrid funds. Okay, so firstly, Nikhil, I want to get in your opinion on this. He's got 4 hybrid funds, no other category of fund in his portfolio. Also, he's done bulk investing, and also he's already 67. He started investing at the age of maybe 65, 66, and now he has only 3 more years. He does have a pension, of course, which I suppose would help him in his day-to-day living. Overall, what would you say is lacking in his portfolio? Also, on the timing when he started investing in mutual funds after he retired. I'm pretty sure that in itself would, not be the most prudent financial practice to follow.
So broadly, as you rightly said, all a thematic fund. And just to explain to the viewers what exactly is thematic fund is, basically they invest 65 to 75% of a portfolio in equities and remaining portion in debt. So this gives the exposure to both asset classes in terms of debt and equity. Equity act as a wealth creator and debt act as a saver in terms of when market falls. Now, thematic fund are good for first-time investors who want to take exposure to equity and also safeguard their money from a uh, far far more volatile which equity happens. Now, again, investing in 4 hybrid fund doesn't make any sense. You should have 1 or 2 hybrid funds that should be good diversification from a portfolio perspective. I'll come to Radhakrishn's specific query that he said that he needs this money after 3 years. Ideally, since you're retired, you don't need all the money together after 3 years. You may need part of this money as a SWP, which is called systematic withdrawal plan, which you need every month on month to meet your retirement expenses. So I'll say that don't look at only from a 3 year perspective. You should look at this as a long term thing. But what you can do is that after 3 years, if you need, for example, 10,000 rupees every month from your portfolio, you can start a systematic withdrawal plan, which is basically they will deduct X number of units from your fund and they will keep on credited the 10,000 rupees to your bank account every month on month. So that you should look at SWP over next 3 to 5 years. But ideally, the horizon of this fund should be very long term because they have equity exposure in their portfolio. Now, coming to consolidation of this portfolio, I'll say that he can stick to 2 hybrid funds. He can stick to Mirror hybrid fund and SDFC hybrid fund. These are two because these are more slightly biased to a large cap. So, being a conservative investor and he's already closer to retire, is already retired. Let's say be in closer conservative portfolio. So, you can stick to Mirror and SDFC. Remaining 2 funds, he can redeem and switch the money in both the funds. But again, look at purely from long term. Don't look at withdrawing all the money after 3 years. After 3 years, you can start an SWP, which will help you to meet your cash flow going forward.
Okay. Also, Nikhil, if any of our other retirees are watching right now, would you say that, let's assume that they do not have a mutual fund portfolio, but they are interested now, would you say equity mutual fund, we know that it's for the long term and you should have a minimum time horizon of 8 years, 9 years, 10 years, preferably, the longer the better. But if they still want some exposure in, the Indian markets, in the Indian capital markets, because, like the India story, do you think maybe a debt fund would be more advisable for them? Because, especially if they are depending on the money, that they could, that they are going to invest and they're hoping that it will get them some money to be able, for them to be able to run their expenses.
See, I'll say retirement itself is like a 20, 30-year goal, right? Because you don't need all the money together, you need money over a period of time. So when you're doing the retirement planning, you need to do a bucketing approach. What we mean by bucketing approach is that any money which you require next 5 to 6 years, that should ideally be in a debt scheme. So debt can be in the form of fixed deposit, debt can be in the form of debt mutual fund, because this will give you a steady return and you won't see fluctuation in the equity market. The money which you require from 7th year to 15th year, which is that money you can put in hybrid fund, which we already discussed in the last question. And the money which you require beyond 15 years, because then you have a longer time frame, that small amount of money you can put in equity portfolio. So how you need to when you get a retirement corpus after once you leave your once you finish your job and when you retire, the corpus has to be divided in different buckets depending on when you need the money and how long you need the money. So retirement planning, again, a lot of people believe that all the money which I've got it should I put in debt. The answer is no, because debt will only give you 6 to 7% return and the inflation will be higher than that. So you won't be able to meet all your expenses going forward. So retirement, some portion of the money of retirement has to be in equity, but again, that money should only be equity which is required after 15 years. The money which you require for first 7 years should be in debt, 7 to 15 years should be in hybrid fund.
Okay, all right, understood. Well, we've got a live caller right now with us joining in, Akshay from Mumbai. Hi, Akshay, good evening. What's your question?
My question is, I've been investing through an SIP in long-term quantum equity fund.
Okay.
Long-term quantum equity fund. And
yes.
It's over 4 years, it's accumulated to 2.5 lakhs. But
okay.
the return has just been 5%.
Okay.
So I'm not sure if I need to continue or I should drop it out.
Okay, is this the only fund you have in your portfolio?
I have a couple of others, but my specific question
is on the quantum large cap. Okay, all right,
yeah,
fair enough.
Thanks.
Okay, Nikhil, what do you make of the quantum large cap fund? It's not been able to deliver very well. It's given our caller only 5%. Do you think he should continue holding this one onto his portfolio?
So quantum long-term fund is one of the worst performing categories. So I'll say that again, when you're looking at investing, you need to invest across 4 or 5 funds, so it gives you diversification. Specific to quantum equity fund, I'll say you can redeem this fund and move to a separate large and mid-cap fund like a Kotak Equity Opportunities, or you can look at Invesco Growth Opportunities Fund.
Okay, I hope Akshay this has helped you out with your question. Okay, let's take on board another email query that we've received from Girish. He writes in to us saying that he's 35 and he got married recently for the second time. His first wife passed in 2007, but he does have a son with her. She left death benefits amounting to 10 lakh rupees and also gold ornaments, which are with her parents. The ornaments are in her parents' locker. And at this point of time, the parents do not want to invest the death benefits in mutual funds, as you know, there's that fear of sorts that perhaps mutual funds are risky, equity markets are risky, etc., etc. And hence they've put all the money in bank fixed deposits. So he has 3 questions. Firstly, how should he convince his ex-wife's parents to invest this amount wisely in index funds or perhaps in any other fund, maybe for the benefit of their son? Secondly, what can be done with the gold ornaments that belong to the wife? And thirdly, which fixed income instruments guarantee 8 to 9% per annum of return for the long terms? Very specific questions and very interesting ones as well. You know, a lot of times we get all this heirloom jewelry from, you know, our grandparents, from other relatives, and it does have a lot of value. So many times we wonder, okay, how can you monetize this? Because maybe in this day and age, nobody's going to, you know, use that jewelry for consumption. For whatever reason, it's out of style, it's too chunky, it's too minimalistic, for whatever reason. So many times we are looking for ways to monetize such ornaments, and I suppose Girish as well has a similar question. So, Nikhil, how would you help Girish out with all of these questions?
Yeah. So first, I'll take the first thing. A
Sure.
lot of people relate mutual funds to equities. Mutual funds not only equities. Mutual funds are vehicle to invest in different asset classes. Through mutual fund, you can invest in debt mutual fund, which is basically like a fixed deposit, which will give you a stable return. Through mutual fund, you can invest in hybrid fund, which is a mix of debt and equity. And through mutual fund, you can invest in pure equity fund, which will be growth-oriented portfolio. So depending on the time frame and the risk appetite, you can invest in mutual funds. So coming to Girish's specific question, if the money requires anything in the next 3 to 4 years or 5 years, you can invest in either FD or debt mutual fund, which will give you a stable return. Now, why debt mutual fund? Because debt mutual fund scores over FDs in a couple of ways. One is that liquidity. From debt mutual fund, you can withdraw at any point of time if once you pass the exit out period, so there's no penalty. Whereas in FD, if you break in between, you have to pay the penalty. Second thing is that debt mutual fund gives you option of indexation benefit. So if you hold mutual fund for more than 3 years, you hardly pay very minimal taxes as compared to a fixed deposit. You pay as per your tax bracket, and if you belong to 30% tax bracket, you pay 30% tax every year on year. So on both this context, debt mutual fund scores better over FD. So I'll say that if you want a stable portfolio, you can look at a debt mutual fund. But consider that money is for your son education, which may be after 10 years or 12 years. Then I'll say that you can convince your parents that if you are in the portfolio, the corpus has to grow more than inflation. If the corpus is growing less than inflation, then you're degrowing your money every year. So if in order to fulfill your the late wife wish of giving good education to your son, you need to grow your money, and that's where the equity mutual fund comes in. So in the short term, it can be volatile, but over a long period of time, that should give you a healthy return than a fixed deposit. So broadly on these 3 contexts, you can speak about that some money you can put in debt mutual fund or FDs. Some money has to put in growth asset to fund your future education, and that's why you need to invest in equity fund. Coming to second question, which was specific to gold ornaments, the best way to do is that you can monetize this asset and put in. If you want the exposure in gold itself, then you can put in sovereign gold bond. Now, sovereign gold bond stands far better than physical gold. The reason being is that first of all, on sovereign gold bond, you get interest over and above the gold prices. So you get 2.5 to 2.75% interest every year on year, which is over and above the gold price. Second, there's no security problem in terms of the storage problem or where to store the gold. You can put in demat form and which appreciate as per the gold prices. And after 8 years, you don't pay any taxes on the appreciation. So all the 3 parlance, sovereign gold bonds scores better over physical gold. If you want to keep money in gold itself for your son's marriage, then you can put this money in sovereign gold bond. Currently, the sovereign gold bond, if you do online investments, you get an additional 50 rupees discount on the gold price. So I think if you want to put in gold, then you can put in sovereign gold bond, But if you want to put in a debt or fixed in an equity fund, you can monetize the money and then put accordingly to your time frame and your risk appetite. Coming to or you can put in children's fund. What is children's fund is basically they invest again sizable portion of your money in equities and small portion of your money in debt, which again will help you for your son's education going forward.
Okay, all right. So that's essentially the word of advice from Nikhil Kothari on how you could go about this entire discussion with even your late wife's parents. Okay, I think we have time for one last query that we've just got. Ravindranath from Pune joins us on the phone line. Good evening. What's your question?
Good evening. I am Ravindranath calling from Pune.
Yes, sir. Good evening.
Actually, I have invested about 5 lakh rupees in Franklin Small Cap Fund through an SIP over the last 3-4 years.
Okay.
But today I am having a negative return of about 5%. So I was wondering whether I should switch over to some better fund like SBI Small Caps or Axis Small Cap, or should I continue with this?
Well, it's a valid question. I mean, Axis Small Cap has been one of those outperformers in a market that's been really, really tough. Just to follow up, Ravindranath, do you have any other, funds in your portfolio?
Yeah, I have.
You have a lot.
Several funds, including Franklin itself. There is a multi-cap fund. I think Focus Fund.
Okay. But you're just particularly concerned about this one because it's
I'm specifically concerned about this one.
Okay, fair enough.
I have one DSP also, fate is similar.
Okay.
Small cap again is not performing. Whereas I understand SBI and Axis is doing
Axis have done well. True. Okay.
Yeah.
Well, let me just tell you this, Ravindranath, that you may look at the DSP Small Cap Fund. In the last 2-3 years, it may have not done well. But by the way, it's one of the best performers in the decade. And I suppose that's where the virtues of long-term investing come in, right, Nikhil? But yeah, we were talking about this, right? About how small cap funds have delivered negative returns for a lot of investors, especially in the last 2-3 years. How would you help Ravindranath out?
So first of all, when you're investing in small cap, you need to have a very, very long horizon, which I say the minimum horizon should be a decade, which you're looking at when you're investing in small cap. And SIP is the best way to invest in small cap because you average out your cost. Coming to specific, when you want to invest in small cap as a category, one thing is very clear that AUM becomes a very, very big factor when you're investing in small or mid cap funds. So select a fund when it comes to small cap category, which is not very, very big in size, because it reduces the fund manager's ability to change the stocks if they want to change his view on particular stock. Because if AUM size is very big, then to redeem that particular stock, you will have a hard time, and because that your stock price will make it on going down. So when you're investing in small cap, look at smaller size fund. That would be a better bet. Coming to Franklin Smaller Companies Fund, has got a slightly bigger in size, so I'll say that you can move this money to other small cap fund. But I'll say that wait for some more time because you have already seen the fall in the whole overall small cap segment. So next 6 to 8 months should be a reasonable time to see some recovery in the small and mid cap fund, or money can be some time to recover this fund, and then you can later change your fund accordingly. But going forward, when you're investing in small cap, look at the size and then accordingly invest your money. Again, considering you have to look at the overall portfolio, you have to make sure that you have fund from across AMC. So when that's the thing, you should have fund across AMC and across category. So if on an overall mutual fund portfolio, you should have more than 4 to 5 funds in your portfolio, and this 5 funds should be from different AMCs and different categories. That will give you sufficient diversification.
Okay, well, thank you so much then on that note, Nikhil, for answering all of our viewer queries and questions. Folks, if we've not been able to answer your question, don't fret. We'll be back tomorrow, same time, same place. Quick break right here on The Money Show. When we return, we'll be talking about SBI's latest and innovative home loan scheme, which will actually give a lot of you home buyers some peace of mind. Stay tuned for that.